So, good evening, students. Welcome to this last day of fantastic session I had with you. Your queries have been phenomenal. So let us see who are the ones who logged in. So we have Dhyanesh, then Alok, Jash, Jyoti, Manoj, Vidika, Mitesh Bhai, Pranay, Vinay. So good evening to all. And now let us continue with the session as we yes. So today being last day for this 15 days whole journey that we had. So you can ask any query, any chapter you feel like, any word that you felt needs to be explained. So let us come to this chapter, the core purpose of this, understanding the functionality. And we were basically on the core business operations of a banking system. Okay. So these are we'll just make a fast recap, overview of banking services and related IT services controls, components and architectures of core banking system risk, security and controls. Right now we are on this part, core banking business process, relevant risk and controls. Then reporting systems, MIS, data analytics and business intelligence, applicable regulatory and compliance requirements. So these we called as main topics. And within this main topic one, we talked about introduction, then overview of banking services that include what exactly banks are doing. And we talked about the new avenues that bankers have got into. So it includes insurance, what we call as bank insurance, then additional services which banks are providing that includes wealth management for high net worth individuals. Uh, Over this last 50 years, banking has evolved to a phenomenal level. So bankers are responding to the changes which are occurring in business just for the understanding purpose at the cost of repetition itself. Whatever services bankers are going to offer, they are going to be there to meet the requirement of the business that exists. So the requirement comes here in business, and then the support is provided by bank. Now, why this chapter is there? The chapter is basically creating the whole link. So you have a business, then you have bank providing those services. And if banker is providing those services, then banker needs some specialized system that we are discussing as core banking system to that extent that is relevance of this chapter to the business as it exists today. Overview of banking services, then core banking system, core features of core banking system that we talked about. Then second main topic, components and architecture of core banking system. Here we talked about the IT environment, the technology components. So that included the various servers which the bankers deploy. We talked about that to make the understanding easy. So banker is going to provide servers. Servers are the main computer which provide services to the users. So users will be bank branches, users will be customer, third parties. So based on the need, based on the requirement of business, bankers are going to add on the servers. So we talked about the delivery channel. Say you can do net banking, so there can be a web-based server. You can do mobile banking, you can have a separate mobile server. So all this, the different channels through which banking services becomes
Recording
part
in
of the
progress.
functional architecture of core banking system. Then we talked about internet banking process. We are all familiar with that internet banking process, the steps of doing internet banking. That was the detailed discussion we had. Then next was e-commerce transaction processing. That was basically taking all cue from your chapter 4, e-commerce, m-commerce. So for any e-commerce transaction processing, banker is an important chain because the payments are going to be processed through banking channels. So how e-commerce transaction is processed there? Banking channel. Then we talked about the case study on deployment. My update to all of you was that the case study that is there in the module is basically a learning case study. It's a remembering case study There are parameters that we all remember, we all must understand while the deployment of core banking system is there at your level. The understanding has to be what has to be looked into. So we did have a chat session on that, that whenever you talk of deployment, what are the considerations the banker must keep in their mind. So you said about data center, data recovery center, disaster recovery center, then future prospects of the bank, the geographical spread, the nature of customers banker is going to adhere to, what is the future plan of the banker. So all that will be part of the deployment study. So that is very, very important. It's a very intensive study. And so whatever you have in the module, basically for remembering, just keep a tag of it. Okay. That is only like you understand that there's something called as a deployment of core banking system. Then when you go for implementation of core banking system, so these aspects, the future, the planning, the technology that you want to use, the functionality that has to be banking system. Then risk associated with core banking system, security policy, internal control systems in bank. With then we talked of, we are on this topic, current account, saving account, credit cards, mortgages, treasury, loans, and trade finance. So let us continue where we left it. So as we are going ahead, so we have Priyanka, Chanchal, Vinay, and Path Sarthi has also joined. Good evening to all. Then main topic 4, the next will be risk assessment, reporting, data analytics, and last is technology and compliances. So this is how the whole chapter is there. Okay. Now we were here, core banking, internal. We have talked about the internal controls in bank, application software, configuration, master transactions, business processes, relevant risk and controls. This was the topic. And here we have talked about this in our discussion, that bank need to have system where the work of one person is automatically checked by others, job rotation, like that. Just give me a second. Then internal controls in banks that we have talked about. Okay. Now this, yeah. So configuration, we did discuss this also. Configuration setting, the user types, master setting, transaction settings, then report. So we had a detailed discussion on that. I told you that just keep a tag of the report. This is very important. And there are many reports which can be added. The conclusion that you won't need to carry is that if there's a field that exists in configuration transaction or master, that report can be generated by banking system. So this is very, very important. And then this we took. Now here we were, core banking business process, relevant risk and controls. Just give me a second. This we talked about, CASA account, then credit gap. There we want to talk about the mortgage loan. So we completed the credit card part. Now we are on the mortgage loan. So let us go to the module. I'll bring the module. So it is here, mortgage. So business process flow for mortgages. Will take these 2-3 topics, the business process flow from the module itself. So what exactly we are looking into? So mortgage loan is a secured loan which is secured on borrower's property by marking a lien on the property as collateral for the loan. Now, please understand that uh, the category of loan is being talked about as mortgage, where borrower mortgages his or its property to the banker. So if it acts as a security, additional security to the banker itself. Now that so these aspects is you have read it in other places. If the borrower stops paying the lend, then the lender will have first charge on the property, and that is based on the agreement that you do with the banker. Now, what are the types of mortgage loans? So let us take one by one. First is home loan. Now, this is a traditional mortgage where customer has option of selecting fixed or variable rate of interest and is provided for purchase of property. So, in fact, just additional discussion on this aspect. So, home loan today, all bankers classify it as a part of their retail loan portfolio. So, bankers are classifying this as a retail loan portfolio. And within that retail loan portfolio, home loan, vehicle loan, education loan, other personal loan are the key uh, components of retail loan for any banker. Within the it, one of the loans, one of the retail portfolio of banker that has maximum coverage, maximum assets is home loan. So all bankers are giving home loan to the borrowers, and this has itself created a huge market for home loans within the country. In fact, just as an example, you go to any commercial project or any residential project that is going on, that is under construction. uh, you go there. If you physically go to the site, you find board of the bankers being put there that this residential complex, this residential apartment has already been sanctioned by A bank, B bank, C bank. So it is telling the uh, probable buyer of the home that if you decide to buy home in this building, this residential complex, this residential apartment, then you can directly approach these bankers because they've already done the due diligence check, gone through the validation of the projects, and you can directly apply it for getting loan. So home loan has become a big portfolio for all bankers. Reserve Bank of India has got detailed guidelines on how you are going to adhere to this. So this example of Reserve Bank of India guidelines for home loan, just keep a tag of it, just have a noting of it. Last part of the today's lecture will be talking about this compliances, regulatory compliances. So we'll link these together for understanding purpose and bring that within the core banking system, how it is going to be incorporated in the core banking system. So home loan is type of first mortgage loan given in the then another concept is top up loan. Now what exactly is top up loan? See, what is happening that over a period of time, suppose you have bought, or your parents or elders in the family have got a home loan and constructed a building, constructed a house 10 years back. So 10 years back, to construct a house, suppose rupee 10 lakh loan was taken. The house has been constructed. Now, over a period of 10 years, suppose the family has grown. So the owner of the that property who has taken the original loan, she goes to the banker and says, see, we want to construct one additional room. Say, suppose you are studying chartered accountancy and a special room has to be built by for you to study CA. So on the first floor, ground floor, as the case may be, another room has to be built. So the for an existing loan, home loan, the borrower goes to the banker and requests banker to give additional facility on the same property. When you talk about additional facility, additional finance on the same property, that is basically called as top up. Now, so the reasons are also given. Top up will be additional amount for refurbishment or renovation. Now, what this is a very good question I wanted to ask you. I thought I'll discuss, but let you answer the question. Because you're taking a loan, so banker needs a security. So my question to you is, what will be security of this top up loan? Take my question. My question to you is, what will be the security of this top up loan? So you answer in the chat. Once you answer, we'll discuss it. Okay, then Next is loan for property that is under construction. So any property that is being constructed, you can take a loan. In fact, all housing loans that bankers give are stage based on the stages of completion. So suppose 10 lakh rupee loan you have taken. So not the whole amount is sanctioned given to you immediately. It is based on the percentage of completion that you have achieving. So that becomes a loan under loan for property under construction. Now, what is the process description? So loans are provided by lender, which is a financial institution such as a bank or a mortgage company. There are two types of loans widely offered. First is fixed rate mortgage, and second is floating rate mortgage. Now, fixed rate means the rate of interest on that specified mortgage will remain fixed over the tenor of loan. Just for example, generally home loans. So let you answer this question. The second question. Second question is that what is the general tenor? Tenor means the repayment period that bankers give for repayment of home loans. So just answer this question. What is that repayment period that the bankers seek in case of home loans? So whatever is the repayment period, the interest rate will remain same. That is fixed rate mortgage. Other is fluctuating rate. Now see, due to geopolitics, Russia-Ukraine war, and the global macroeconomic issues that are coming up, uh, COVID government, various governments across the world had some COVID benefit passed to their citizens. So all this is having an impact on inflation across the world. So inflation today is a worldwide phenomena. It is not country specific as of date due to geopolitics and other things. So when inflation is in a rising trend, then all central bankers across the world generally have one of the ways of controlling inflation is increasing the rate of interest. So you have that repo rate has been increased, reverse repo rate has been increased. So when central banks increase their reverse repo rate, then this impacts the bank's own rate of interest. So what is happening today? The trend that we are looking is increasing rate of interest. Now, suppose I had fixed rate mortgage, so my rate of interest will be constant. But if I have floating rate of mortgage, then it is increasing. Today's situation, it is increasing rate of interest. 5 years back, it was decreasing rate of interest. So there are always benefits of comparing fixed rate mortgage to floating rate. So these are the parameters based on which the banker may give. So the borrower and banker agree that this loan, this mortgage loan is going to have a fixed rate or floating rate. Then the borrower customer approaches the bank for a mortgage, and then approval is there. Customer gives rest you can do. So the basic process will be same. Customer is going to give the loan application, give KYC documents. There is going to be validation of the KYC documents, validation of the loan that the customer is seeking. That also includes the suppose the loan is taken and it has to be repaid. So what is the customer's earning? How the customer, he or she, will be able to repay the loan. So those are the considerations which are there. So which are put along with the documents that the probable borrower submits to the banker. Then the loan officer reviews, sorry, the loan officer reviews the application. Once loan officer is satisfied with the basic data, basic application, all things have been received, then the loan officer sends it to the credit appraisal team. So that credit appraisal team is going to do a detailed analysis. In fact, today, just understand, today, all credit appraisals which bankers are doing, so it's very technology driven, data analytics, business intelligence, and one of the things that we all can add is they also includes AI based analysis, artificial intelligence. Within this credit analysis, that word is important, CIBIL score. In fact, all of us are getting WhatsApp messages, emails. Please check your CIBIL score. So CIBIL score is, it's basically an agency, Credit Information Bureau of India Limited, that generates a credit rating of all the individuals. So that credit rating is basically indicator of the financial stability of the person, the capability of the person, whether the person has an existing loan that is to be repaid. So that is what this credit indicator is this. Once financial eligibility is determined, then along with customer document, the details are sent to underwriting team for approval. So all these things, once analysis is done, credit appraisal team goes through, then you send it to the next team. Then underwriting team looks for the applicant's history. Underwriter will ensure that loan provided is within the lending guidelines. So this is important. Please carry this word lending guidelines. Like we talked about this home loan. Today, home loan is a big portfolio for all banks. So Reserve Bank of India has a detailed guideline how to give home loan, how much value home loan you can give, what parameters banker needs to follow. Can a person get home loan for, say, just for example, I'm raising a word, second house also. So all these important considerations are there. They are part of the Reserve Bank of India guidelines. So whenever borrower comes to a banker, so this underwriter validates whether all things are proper. Then fifth is the most important point in this loan mortgage. Just remember fifth point, not only for today's discussion, but carry this point for any discussion about loan. In fact, when you go for bank audit and you check loan files, fifth is one of the point lot of emphasis is made. It is about the property on which the loan is to be given. So this is where lot of disputes, lot of conflicts, in fact, lot of banking frauds come across this multiple financing on same property. So this requires lot of detailed analysis. So what bankers have done today, they have got specific team. So legal teams for validating the genuineness of the property, teams that ensure that the what you say property papers are proper, they are not fake, they are not duplicate. Teams that check that whether there is an existing loan on the property which the banker is seeking. So this has been made, and you can add few updates here. Uh, Based on this lot of centralized registration processes for properties have been put in through. So one of the process is CERSAI. So that is how bankers keep a track of what is the loan status of the property. Then verification of property to determine approved plan, that municipal corporation certification, everything. Then legal valuation team assesses the value, assesses the loan amount, rate of interest, and all these things. Then a loan agreement is created for the customer. Customer, he or she agrees to the loan agreement. I am okay with that. Go ahead. Signed letter is received. And once all, now, when banker is going to give loan on a property, so banker is going to create a lien. So to create a lien on property, what you require is the original property documents. So those original property documents are received by the banker. Suppose I am the customer and I am handing the original property document to the banker. So I require a confirmation from the banker that I have submitted you the original property document. So that confirmations are created. Then an agreement is written. And once all this basic process is completed, the loan is disbursed. Now, this has been given as a flowchart in the module. Let us just see. Yeah. So it is here. So this is how the business process of the mortgage goes. Now I put some questions. So let us first review the answers to the questions. Good. So my first question was that when you have a top-up loan, so and that loan is going to be given to an existing borrower who already has a home loan, and he or she is seeking refurbishment, additional rooms, additional structures to be constructed. So what is the security? So let us read the answer to the question. So Jyoti says the same home. Good. Dhyanesh says the home. There was a inbuilt point. Let me just see. Then gold fixed deposit. Yes, it can be there, Vidika. So that is there. The house which is already under bank's authority. Yes. The house, the existing house. Primary is the house. I agree. Okay. The same property. Good. Now, so the key, why banker may be interested in giving a top-up loan? See, banker is going to be interested in giving a top-up loan. Why? Because Suppose the original loan was given 10 years back. Now, what has happened? The land prices, the property prices over 10 years have increased. So what bankers makes a reassessment that what is the present market condition of property, and what it's practical to understand that unless there is something that is exceptional, uh, generally the property price trend is increasing. So the property that might have been rupee 10 lakh, say 10 years back, it may value 50 lakh, 1 crore, as the case may be. So this increase in the value of property is that motivates the banker to give a top up loan because the security is already there. So all of you who have answered that the same home is the security for a top up loan, that was the answer that was being sought. The idea was that why on the same home loan or same home, same property, banker may be interested because now the property prices have increased to a very high level. Okay. Then second question was the repayment period. So 5 years, 15 to 20 years, 10 years, 5 years, 5 to 10 years, 20 years, 30 years. Yeah. Then, okay. So Alok has a question. What is notarized? Then Kozema, mortgage hypothecation. Okay. I'll just try to answer that. So see, notarized is basically notary is a defined person who does a specific function. Notary is a defined person who does a specific function. So whenever you go to this say court, district court, or so there are persons who are defined as notary. So notary basically what the notary does, he or she certifies the truthness of the document. Okay. So he or she certifies the truthness of the document. So this is true. Just say, for example, you have to send, say, a birth certificate, and then the authority that is asking you to give a birth certificate, it wants a birth certificate notarized. So notarizing the birth certificate will mean that the notary, he is going to check the original birth certificate. On the copy of it, he is going to put the he or she is going to put the seal and say that this has been verified from original. So getting it over notarized adds to the what I can say authenticity of the document. That is what notarized. So notarized is a public person who provides this functionality within the framework of the evidences, within the framework of requirement of law. So that is what notarized is there. Then Kozema and Jyoti, you have asked difference between mortgage hypothecation and pledge and mortgage. Please, it's a very, then there is a bailer, bailee, and all those words. So they are not part of our discussion. So let us not give time to that right now. Okay. Yeah. So Vidika says that generally the repayment period is 15 years and it may be linked to the age of the borrower. But yes, so it can be the way banker looks to that person, the property, the earning capacity. That is great. Then next part. Now this is going to be important. The risk and controls around the mortgage process. So let us take them one by one. Again, I'll try to give examples to that. First, again, incorrect customer and loan details are captured, which will affect overall downstream process. Now, please understand what the terminology is. That in your core banking system, the customer and loan details have been incorrectly captured. Means, so for that we just discussed just now, that the nature of the customer, the eligibility of the customer, the loan, they said tenor of the loan, the question that you have answered. So anything that is incorrectly captured in system, it is going to hit a huge impact on bank, because then all the processes in the bank will be determined by that. So the key controls are, there is a secondary review performed by an independent team member who will verify loan details captured in core banking application with offer letter. This is very, very important that whatever loan details are captured in system, they need to be verified by an independent body. So bankers have this, most of the bankers have built what they call as a second check. So whatever updates are there for a loan, a team is there which makes a check that yes, these details have been correctly captured in system or not. Then incorrect loan amount disbursed. Now, this is important. Okay, this is very, very critical in terms of disbursement going wrong. Now, let us see what is the impact of this. Again, there is a secondary team performing, secondary review performed by an independent team who will verify loan amount to be disbursed with the core banking application to the signed offer letter. Now, see, this second point is uh, very critical error that the banker is disbursing an incorrect loan amount. Now, how does it happen? If you read first and second together, so if first there is a secondary check, that means the person's customer's details have been correctly fed in system and it has been correctly checked, validated. The loan amount also has been there and it has been checked. So once the correct loan amount is fed in customer database, customer requirement sheet, then if after that also incorrect loan amount is disbursed, that means there's a big flaw in system. Please understand. Okay. So first and second have to be read together in terms of first is a basic validation process. If first is going correct, and if the second error is there, that means it's a big thing that has happened. Okay. This may indicate existence of fraud also, if first was going correct. But if first is not going correct, then second becomes a very comfortable possibility that if you have not checked the basic details fed in the system, then the chance of incorrect loan disbursement will be there because there was no checking done. So if first is true, first has been validated, and if second happens, then it's a good indicator that there is fraud in the whole process. But if first is not good, then second can happen generally also. Okay. So see, this is how you learn. And please understand the risk and controls that you are reading. Why it is being taught along with core banking system? Because today the banking operation is system driven. So all this risk analysis has to be done through system itself. This is also relevant, also pertinent to your discussion in audit also. So what I want that these are good examples which you can always carry in terms of lapses of internal control, deficiency of internal control. We have already talked about SA 260, SA 265, communication with those charged with governance. So if these are not being done properly, then you as an auditor can communicate. And please understand, this is applicable while you're doing an auditor, while you're doing audit during articleship. This learning is important. That is why these topics are being brought to you, because their impact is going to be huge in the terms of the way whole banking system is continuing working and is being processed. Then interest amount is incorrectly calculated and charged. Again, if first is correct, that means rate of interest is also correct. Then if this incorrect calculation is there, that means the formulations for calculation interest is incorrect. That means my basic configuration setting for formulation checking has to be improved, has to be looked into. Then what is the control now? Interest amount is auto calculated by core banking system based on loan amount, rate of interest, and tenor of loan. So there's nothing that has been left out. It is already incorporated in system. So if you read the risk and the control, so risk is about that the risk used to exist. Control is saying that now that risk has been compensated, mitigated. Mitigate means the impact of the risk has been reduced. Why? Because now everything is being auto-calculated. But auto-calculation is also going to be subject to point number one. What is point number one? Capturing of correct customer data. In fact, just for the sake of it, because this is a very important, relevant topic to understand and discuss, See, in banks, many types of audits are being done. So one of the audit that generally chartered accountants do, like we talk about statutory bank branch audit, we talk about concurrent audit, we talk about stock audit, we talk about revenue audit. So revenue audit is one of the audits where the CA goes and checks the bank system to identify areas of revenue leakage. Areas of revenue leakage means where the banker has lost revenue due to some mistake. In those areas of revenue leakage, one of the core findings that the CA or the practicing chartered accountant who is acting as a revenue auditor. So there is a recovery you do. So you go to a branch, audit the system, generate a report. In the report, you say this branch has lost, say, rupees 1 lakh in the last 12 months. So then you have to give details why this 1 lakh rupees was lost. So most of the time, the mistake is that the bank system did not update the interest rate correctly. So the third point is so very important. In fact, the third line itself is, if you read the third line, it's a very detailed practice opportunity that most of the chartered accountants across India do, that they do a revenue audit of the banks. So revenue audit of the bank is focused on identifying revenue leakage. What is the main source of bank? The major source of bank is interest income. So that is this third line. So it is very, very, very important. Most of the time, the interest that is incorrectly calculated is due to uh, non-update of rate of interest in the system. Okay. Then unauthorized changes made to loan master data or customer data. Again, because the risk starts with unauthorized changes, that means the controls, there is a gap in controls. That means more controls have to be put in place. System enforced segregation of duty has to be there in core banking system, where the person putting in transaction, she cannot approve its own transaction, and reviewer cannot edit any details submitted by person putting the data. So clear cut responsibility segregation, the person who puts the data and person who verifies the data. If, and that is there. So please understand, the control exists in core banking system. Maker checker, we have taken very good example on that cash payment. So maker checker exists. If still unauthorized changes are being made, that means there is what we call, you have read in your audit, the when frauds occur or types of fraud. So one of the headers that you have read is fraud due to collusion. Collusion means where two people join together. So with this control that already exists in bank system, still if unauthorized changes are being made, that means there is a possibility of collusion in bank system. Okay. So let us go to our slide. Then we'll come back. I see a lot of queries have been put by you. We'll go back to the queries. Just give me a second. Yeah. Good. So same. So difference. So that we are not taking right now. Okay. So risk and control in mortgage process. So we talked about home loan, top up loan, loans for under construction property. Rate of interest can be fixed as well as fluctuating. Okay. Now, so this is the process that has been discussed in the module. So see, keep yourself to that. See, because bankers, this is only one part of the process that the bankers should be doing. Only for knowledge, please understand, only for knowledge, understand, bankers, the major part of banking business is commercial advances. Commercial advances means advances for business. Those include cash credit loans, term loans, infrastructure financing, project financing. So that is a very detailed part. But because, just keep a tag of it, remember, keep it in your mind, that is also part of the operations that the bankers do. But right now, the module is restricting itself to mortgage loan, because discussing those details here would have made it very, very huge. aspect to talk about. Then coming to the next, that is treasury process. Again, we'll go to the module. Yeah. Okay. So before I go there, I want you to tell me what is a treasury? What is a treasury? What is your understanding of treasury? Then we'll go to the treasury process. How do I define a treasury of a bank? Okay, so let us go ahead. Now, so I've asked you to read financial dailies. So I think I understand you all are doing. Okay. Then, uh, one of the few things I also want you to do now. So I'm making it slightly day by day much tougher for you. So I must have talked about that. What you can do is get yourself into habit of reading listed companies' balance sheet. So two things I expect from you. I understand that we have already talked a lot on reading financial newspaper daily. So you all need to read your financial newspaper daily. And now I want you to read your listed companies' balance sheet. Now the question will come that which listed company balance sheet you need to read. So what you can do based on your syllabus, like say for example, suppose you have got this electricity company accounting. So you look for listed companies which are in electricity business. So take that balance sheet. Say for example, in accounts you have bank. So take balance sheet of banks, listed banks. Say you may have insurance. So if insurance companies are listed, take those balance sheets. So I want you to download and understand all listed companies balance sheets are public document. You can search by name, download. It is available in PDF. So why I've shared this? Because I want you to do this. Download listed banks balance sheet. Do read. Read it as a novel. Okay. And once you start reading it, you'll understand what exactly is going about. Now, when I asked what exactly is a treasury process, a lot of things is there on the screen, but let me see what you have answered. Yeah, so Jyoti says where money is kept. Nafisa says deposits. Treasury, till I know, is the reserve of money which government or gold or such other reserves kept with kings in ancient times. Okay, just storage of public cash and disbursement. Priyanka's, that is Parthasarthi. Priyanka Malge says management of money. Dhanesh, management of money and risk in business. And Khozema says, yes, TCS balance sheet, you can take Khozema. And you can take other software company balance sheet also. Yes, yes, agreed. So this management of money, good. Now, please understand why I brought this topic of bankers' balance sheet. So when you talk of treasury operation per se, bankers have two main business income. One income is interest, and other is income from treasury operations. So if you look to in fact, just have a recall of your format of balance sheet P&L that you have studied in accounts. So this treasury income is a separate head to be disclosed in P&L account. So investment categories are GSEC. So that income that bankers earn through investments, those have become their treasury operations. So investment in government securities, other investments, CPs, that is commercial paper, CODs, certificate of deposit, security receipt, PTC, pass-through certificates, units of mutual fund, VCF, venture capital funds, real estate funds, debenture and bonds. So they are where banker invests, whatever they earn, that is basically called as treasury operation, including forex and derivative OTC transactions. So then we are not going into detail. Option swap, you all know much better. Future, foreign exchange, forward interest derivatives. So all these income that bankers do other than form their core business activity, that is lending money. So by lending money they earn interest. By this investment they earn additional income. So this additional income is part of the treasury operations of the bank. Just for sake of remembrance, please understand we talked about two ratios, SLR and CRRs. SLR is statutory liquidity ratio. So bankers have to invest a specified percentage of their time and demand liabilities into specified investment. One of the investments is that is given in the head is government securities. So SLR investments also give birth to the treasury income of the banker. Okay. So core areas of treasury operations. The core area of treasury operations in bank can be functionally divided like that. So this is for understanding purpose. Okay. So why this discussion? Because please understand, treasury is a separate category of business that the bankers are into. So for this separate category, the core banking system need to have a separate functionality. Let us understand, let us link this discussion to the start of the topic we talked about: configuration setting, master setting, and transaction setting. We talked about configuration setting, master setting, and transaction setting. Now, I am putting this question to you. Try to answer. The options will be configuration, master, or transaction. Of these three, you have to answer one. Now, the question is: Reserve Bank of India has given license to a bank that cannot provide treasury operation, or bank that can must not enter into treasury operation. So the license restrict a banker from doing treasury operation. So this is the license. The bank is going to buy a software. So the bank who got this license, which is restricted that the banker cannot do treasury operations. So banker has bought a core banking system. This core banking system is going to be customized for the banker. So when you do the customization for the banker, I want you to answer that you cannot do treasury operation. That is a mandate. You're customizing a core banking system. So this customization will be affecting configuration setting, master setting, or transaction setting. Let us do it. Let me repeat the question. It's a good question to understand and learn. So Reserve Bank of India has given a license to a bank saying that the banker cannot do treasury operation. The banker has bought a core banking system. Now the banker is getting it implemented at deployment. Point number 6, deployment. So this banker is deploying the core banking system. When it is deploying the core banking system, this restriction of Reserve Bank of India will be affected by changing configurations, masters, or transaction. It's a good question to answer. So I expect you to say configuration, master, or transaction, where the effect will be given. Okay. So your correct answer will help me understand that how you have captured the difference between configuration setting, master setting, and transaction setting. Okay. Then, so now first core area of treasury operation. Now please understand. So here we were. So why this distinction, why this discussion is being brought? Because when you do treasury operation in bank, so you need to configure your core banking system in that manner. Okay. So you have the front office. It is also called as the dealing room, wherein the dealers enter the deal into various corporate and interbank counterparties. Now, please understand, or it is always better to see what is going on. So I'm just creating an example for you to understand what exactly is a front operation doing. Okay. So that you understand it by, you need not remember it, you remember it by working the definition. Now, let us take it. See what happens. The bankers have to maintain statutory liquidity ratio. What is SLR? I'm reading for you. SLR is that a specified percentage of bankers' time and demand liabilities as existing on second Friday of the second fortnight of month has to be kept invested in a specified category of security. So Reserve Bank of India gives a percentage that this is the statutory liquidity ratio uh, reserve percentage. So say for example, 20% has to be invested into GSEC, for example. Now what happens? Bankers make a monthly assessment that what is their SLR investment. Suppose that today the SLR investment is 20%. Tomorrow, the Reserve Bank of India says that now banker has to invest 25%, means 5% additional you have to invest in SLR. Okay. So this 5%, how you are going to invest? So you are going to buy from the market. Who is going to buy? Banker is going to buy. So all this doing that transaction, that so the system says that 20% is what we have. What is required is 25%. So system gives an input. So system is giving input to what? The front office. So this is what the front office does. So this front office is basically now it is going to deal with the third party saying that we want 5% investment to be made. So this is where the interaction goes. Now read, so you'll get a good understanding of it. So front office consists of dealing room wherein the dealers enter into deal with various corporate and interbank counterparties. Now let us read again. So bank has to invest how much? 5% more. Now 5% more means, just understand, 5% for you and me is 5. But when it is converted into bankers value, it may run into 500 crores, 1000 crores, 10,000 crores based on the size of the bank. So this much additional investment has to be made. So banker is going to invest to whom? The person, the entity that is giving the maximum rate of interest. That means the front office is going to deal that we are investing in so much money, so we want the better rate of interest. So this is how they deal. And there, if you can read it, deals are entered by dealers on various platforms, and the name of the platform is there. You can just remember it. Okay. So it can be through routers, trading system, telephonic, brokers, and like that. So this dealing is done. This is how they talk to each other that, okay, we want to deal it. Then dealers are responsible for the counterparty limits and everything that is part of the discussion. But you get the idea that what the front office is doing, whatever information they get, that this has to be done, they execute that. Then middle office. Let us read, and then the same example we will create middle office. It includes risk management, responsibility for treasury, accounting, and documentation of various types, input into regulatory reporting procedure, producing the financial results and analysis, budget forecast for treasury business unit. Risk management can range from agreeing overnight cash positions for trading room through full risk modeling associated with, say, derivative trading and hedging. Now, what middle office is doing, just keep the first word with you, that is core is risk management. So what middle office is looking to the whole portfolio of investment made by the banker, the risk it has, and how it is managing it, linking it to the present market situation. So it's basically analysis, okay, how things are going. And back operation we have talked about. The one that is going to say that this is the gap. The mainstream role of back office is in direct support of front office. This includes verification of confirmation, settlement, checking existence of valid and enforceable swap. It's a technical word, just remember it. But what you are basically back operations. So the example I gave, that my present SLR is 20%, I have to make it 25%. So this calculation is done by back office. They transfer this calculation to whom? Front office. So if you read the first line, the idea will be clear to you. The mainstream role of back office is in direct support of trading room or front office. This includes verification by confirmation, settlement, and how things exist. Rest, there are quite technical updates. Just carry them. But the core idea I have made clear to you. So these are the three operations: front, back, and middle. Then we'll go to the process flow, but there's a question that I've asked you. Let us see how you answered the question. Good. So my question was that when, as a banker, where my banking license says I cannot do treasury operation, and me as a banker, I have bought a core banking system, a core banking software from multiple software vendors. The name is in the module, and I'm customizing that core banking software for my use. Okay. Then what changes I have to make, where the changes will be made. So the three options were configuration, master, and transaction. Let us see. So I'll read the correct ones. So Jyoti, configuration, Nafisa, configuration, Jash, configuration, Khuzema, configuration, Dhyanesh, configuration, Vinay, configuration, Varsha, configuration, Varsha Shetty, configuration, then Parthasati, configuration. Yeah. Okay. So configuration is the correct answer. So most of you have answered correctly. If you have not answered configuration, but there that is. So configuration setting is what? Which defines the purpose of the software, the functionality that me as a banker is going to use. Then a lot of you have put queries. So let us see. Nostro and Vostro account. My account with you, your account with me. You have read in bank. Okay. Then there's one more question. Front office, front back office similar to front back end. Yeah. Yes, yes. Over the counter. Yeah. Look, over the counter means it's a way of defining. So over the counter means I can sell, like you see, I'll give a very different example for understanding purpose. You know, when you go to a medical store to buy drugs, so there are few drugs which are called as OTC, which you can buy, sell on over the counter, but few are called as prescription drugs. Prescription drugs means those drugs you can buy only after reducing the doctor's prescription to the medicine shop seller. So when you say over the counter means you can directly buy sell. So no further validation is needed for that transaction, that you call as OTC, over the counter. Okay. Just because Nostro was asked by yeah, Kuzima. So Kuzima, just keep a tag of it. There are two basic accounts, Nostro account and Vostro accounts. Okay. So one is it's more going into banking. So just keep the words. I'll request you to read in your bank audit. Means bank audit, it will be there. Your bank accounting, it is going to be there. Nostro and Vostro account. Yes, please read there. And just to keep you aware on that, this reconciliation of Nostro Vostro is a big transaction to be done. Okay. So now the operations. So process flow is there, front office, middle, back office. So we have pre-deal analytics. In fact, this flowchart is good because it summarizes. Suppose the question comes that what front office is doing, what middle. So this 1, 2, 3, 4 points are given. You can directly do it. Okay. So pre-deal analytics, trade deal capture, position management. Middle office does risk management, ALM, asset liability management. Okay. This word has come very specifically. Anyone who wants to comment in the chat what exactly we mean by asset liability management? I'll just need 10 seconds. I'll be back here. Asset liability management. Just try to answer that. Yeah. Okay. So middle office looks for asset liability management, price and valuation, position and limit management, and back office is reconciliation, confirmation, settlements, and accounting. And then the process is here so that the rest you can do. So I'm expecting you to define asset liability management. It's a very important topic. It is there in your audit also, and probably in your accounts also. Then this is good. Again, this is going to be a deep impact discussion. Risk and controls around treasury process. So, see, now what is my idea that once we understand what exactly is going about, then this understanding is going to automatically improve. So, unauthorized security set up in systems such as front office, back office, appropriate segregation of duties, and review controls around security, master setup, and amendment. Please understand this 1992 Harshad Mehta scam, and that lot there you already have a movie on that. There's a web series on that also. So those of you who just want to learn banking on the other side, how that fraud was done. So, and what controls are needed. So that first line, unauthorized security setup, is a good indicator that this risk can lead to that fraud. So proper segregation of duty is needed. Then inaccurate trade is processed. Again, segregation of duty is needed. Proper review controls are there. See, please understand this treasury operations. Every risk is going to be hugely material, because I have already told you treasury operations are not like rupee 1, rupee 2 transaction. Based on the size of the bank, they can run in crores and hundreds of crores of rupee. So any risk that you are looking is material. We have talked about the concept of materiality. So in treasury operation, any risk that you are reading is material itself. So that means the impact has to be there. So it is going to create a huge financial impact. Just keep yourself aware about that. Unauthorized confirmations are processed. So ensure that complete, accurate confirmations to be obtained from counterparty. Uh, please understand, each of this line is a discussion worth 2 hours, 4 hours. I've told you it is very, very material. Uh, Impact is going to be huge. So do carry this. Okay. Then insufficient securities available for settlement. Effective controls on securities and margins. You know, this, you've read the word short selling. Short selling means that you sell that you don't have in pocket. So share market, that is used short selling. And this treasury operation has a direct indirect link to share transactions, share markets. So insufficient securities available for settlement. So now you're looking at from the other side. When I said, it means for treasury operation, you as a banker can be buyer of security as well as seller of security. In this case, you're basically seller. So you don't have the security and you have sold it. So that means there is some gap. That is why it says effective control on the securities and the margins put. Very, very, very important. Believe me, every transaction is very, very critical for business operation. Incomplete and inaccurate data flow between system. This is a disaster. Lot of gaps are there. If this happens, then what you need to do? Proper inter-system reconciliation, interface, and batch processing controls. So everything has to be looked thoroughly. Insufficient funds are available for settlement. Again, this is from, you are a buyer and you don't have money. So control side, these are the corporations which ensure clearance of this transaction. Clearing Corporation of India and the NEFT RTGS settlements to ensure the funds are available and timely settlement based on the availability of funds. Just keep a tag of them. Okay. Then controls in correct nostro payments. Now, Khuzema did ask, and it has come again. Controls at nostro account reconciliation and payment. Nostro refers to an account that a bank holds with a foreign bank in currency of that country where the funds are held. Let me give it an example. State Bank of India has a bank branch in State Bank of India has a branch in New York, and all State Bank of India settlements to US are done through that New York branch of State Bank of India. So there they have got a US dollar denominated account where all these foreign currency transactions are done. So nostro account refers to account that a bank holds with a foreign bank in the currency of that country where the funds are held. So what State Bank of India will do now, because State Bank of India is not printer of dollar, it is dealer. So it has a say account with say American Bank. So State Bank of India has a Nostro account with American Bank. That will be a dollar denominated account in the American Bank. Vice versa is, so this is my account with you. So I'm State Bank. I am having account in the foreign country, foreign currency. Other is Vostro, your account with me. So that will be in rupees. So these settlements are very, very critical in Nostro and Vostro account. Keep it at this only because then it become technical for bank purpose itself. Good. So my question was ALM, asset liability management. So Jyoti, management of assets and liability. Manoj, deposit and advance management. Management office, Sharon, working capital. Okay. Then assets, Varsha City, assets. Risk due to liability and asset. Yeah, Satyam's scam was not this, it was an audit related scam, Kuzema. Okay, we have a new student, Akash. Manoj says 420 IPC. That was in relation to that scam I was referring to. Okay, now this. I thought you'd be okay, but let us learn. So please understand asset liability. Just remember it. Why I'm sharing this definition because this word is coming here and it is very important for your audit and account. So asset liability management is what? Creating a, or rather analyzing the maturity pattern of assets to the maturity pattern of liability specifically for the banker itself. Now, what is maturity pattern of asset? That I have given loan. Say we talked about home loan. I asked you to give me the tenor of home loan. So generally home loan may have tenor repayment period of 10 years to 20 years. When banker gives a home loan, this amount is reflected in the asset side of the balance sheet. So what will be the maturity pattern of the asset? Whatever installments bank is going to receive every month for the 10 years. That is maturity pattern of assets. What is maturity pattern of liability for a banker? Say you do a fixed deposit with a bank, 5 years, 10 lakh rupees. So for bank, after 5 years, they will have to pay, for example, 11 lakh rupees, 1 lakh interest, for example. So that means after 5 years, banker has to pay 11 lakh. So that becomes cash requirement after 5 years. What is the cash source, cash funding? This installment that banker receives over the next 10 years. Now just take this example. So this asset liability management. So what is it? Matching the maturity pattern of liability to maturity pattern of assets. That is what you call as asset liability management. Just to bring it to what I'll be doing, I'll be linking ALM to the requirement of system. Just take this example. You tell me what is the risk. Okay. Suppose I go to the bank, I deposit 10 lakh rupees FD. मैं बैंक गया हूं, बैंक में मैंने 10 लाख रुपए की एफडी जमा करा दी है. 5 साल बाद उस एफडी के अगेंस्ट में मुझे 15 लाख मिलेंगे. तो बैंक को मुझे कितने पे करना है? 15 लाख. So I have gone to the bank, deposited 10 lakh in the bank for 5 years. After 5 years, banker is going to pay me 15 lakh. So how much I will get? 15 lakh after 5 years. But today, bank has 10 lakh rupees cash because I have deposited 10 lakh. What bank has done? Bank has given this 10 lakh as a housing loan to a person. The repayment period is 20 lakhs. So जो 10 लाख की एफडी मैंने बैंक में की, बैंक ने क्या किया? उस अमाउंट को एक व्यक्ति को हाउसिंग लोन दे दिया 20 साल का. So the banker has done, it has given a housing loan for 20 years to a person. So what is going to happen? Just understand. Today bank got 10 lakh. I got FD receipt. I'll come to the bank 5 years asking 15 lakh. What the bank has done, it has financed that 10 lakh and given a housing loan to a person with a installment of 20 years. Now, bank will receive installment just for the sake of it. Say 10 lakh rupees is there and Over 20 years, bank earns 10 lakh as interest. So total 20 lakh rupee bank will receive in 20 years. Let us do a very simple mathematics. So in 5 years, how much cash bank will get? 5 lakh. I After 5 years, when I come to get my FD back, I have to take bank has to pay me 15 lakh, but it will have available cash only 5 lakh. This mismatch is what is called as asset liability management. And understand this asset liability management has to be incorporated in system, and banker has to make an analysis of what is their cash requirement after 1 year, 2 year, 3 year, 5 year, and beyond 5 year. This requires lot and lot of system understanding and integration. So this is what is so important in core banking system. It's a slightly a discussion at a higher level, but this tells you what core banking system is doing for bank like that. Okay. So that was sorry. So we talked about this. Then loan and trade. Yeah. So we'll go to the next topic. But then because we have to start a new topic, so we'll just take a break. But I'll first answer the queries. Then we'll take our break. Okay. Good. So Alok, so this is very good. It's a, each. I wanted someone to ask this question. Uh, yes, Alok. Now please understand. So asset liability management is a very different topic. How does bank manage it? They have to do a lot of financing, refinancing. In fact, just giving a hint, you read this, many banks give this special deposit scheme. 555 days, you get 7% FD interest. Now, 555 is, if you take by year, it is between 1 year to 2 year. So 1 year FD is 6%, 2 year FD is 6.5%, but 555 days FD is 7%. Why? 0.5% additional for beyond 2 year FD, because what banker has done that it has made its asset liability management analysis and found that there is a gap when roughly at 555 days from today where the asset is not matching. So the bankers bring this very additional products to manage their ALM. It's a very big topic, but that is one of the way. Yes, so asset liability management will also help banker identify the availability of cash that they can put in SLR. So they are linked topics, but the link is quite far off. No, Alok, bankers keep amount as gold and cash because gold and cash is part of SLR, but basically specifically part of CRR, cash reserve ratio. So they have to keep it. So it's 7:13. So we are having a break, 10 minutes, 7:23. Gold sovereign bond of RBI, also special deposit. I don't have a right answer right now. Look, I'll have to read through this. Okay. So you said you read it in BCom. I'll carry that. I'll have to run through this. Okay. Now let us continue with the next one and trade finance process of a bank. The business of lending, which is the main business of bank, can carry certain inherent risk. Bank cannot take more than calculated risk whenever it wants to lend. So, and lending activity has to necessarily adhere to certain principles. Now, these principles again have to be incorporated in the core banking system. So, let us talk about one by one what exactly are the issues that the banker is trying to address by this. So, first is we have talked about this fund based and non fund based credit facilities. In fact, we had a question for you to answer. So fund based basically means where bankers fund is involved, where bankers cash flow is affected, that is fund based. So cash credits, ODs, demand loan, term loans, bill discounting, these are fund based, where at the time of the grant of facility, bankers cash flow is hit. Non-fund based is where at the time of giving the credit facility, bankers cash is not involved at that moment of time. So LCs, BGs, the bank guarantees and letter of credits are where the bankers funds are not involved at the time of granting of facility. Now, I'm asking you this question. Is it possible that a non-fund based credit facility given by a bank over a period of time becomes fund based? Listen to the question. Is it possible that a non-fund based credit facility given by a bank may become a fund based over a period of time? We have to say yes, no. Okay, let us continue. Then we'll have a very good discussion on this one. Okay. Overall, the process flow of above activities remains the same, provides a high level summary of these processes. So both for non-fund based and fund based, the basic process is same. There will be some subtle differences based on the nature of funding that you are seeking. Say, for example, if it is cash credit, some additional detail. If it is demand loan, term loan, some additional detail, some different detail. If it is LC, BG, then other details. So like that. Oh, good. So claps for all of you. 100% of you who have answered to my question, that can non-fund based convert to fund based over a given period of time? Yes. So I think I need not explain because you all know it. Great. So let us run through this fast. So customer master creation in loan disbursement system. So understand that when a potential customer has been identified by the relationship manager, then details are sought from the customer, and the nature of details will be directly dependent on the nature of facility. So please understand what are the nature of facility. At the top, it can be fund based or non-fund based. That is the top L1 category. And then if you go to L2, within fund based, it could be cash credit, ODs. ODs is overdraft, term loan, demand loan, bill discounting. Within non-fund based, L2 can be letter of credit, bank guarantees. So based on that, the nature of documentation will be there. Some core KYC documents will always remain the same, but based on the nature of facilities, some subtle differences are bound to be there and they will be there. Once the potential customer agrees for availing the facility, the relationship manager requests for the relevant documents, KYC and other documents to go to allow the banker to go ahead with the sanction. The documents received from the customer are handed to credit team, then the same risk assessment. Credit team verifies the document, assesses the financial and credit worthiness of the borrower and issues a sanction letter to the customer. So based on this, the sanction is given. Sanction letter details the terms of the facility, credit limits that customer enjoys, how much loan can be offered to the customer. Now, this is talked about in customer risk credit line. We read about this word credit line. So here that is again relevant, that when you are making the assessment, when the credit team is making an assessment that how much loan a customer can be given. So that is what they call as credit assessment. Once the customer agrees to the disbursement, then credit team prepares a pre-disbursement certificate. This word came in earlier chart also. So I told that pre-disbursement certificate is more to do with the asset side of the bank, not on the liability side of the bank. So if you are looking at a process, then pre-disbursement certificate will be more relevant where the result of the process is asset of a bank. What is an asset of a bank? Advance. So pre-disbursement certificates are relevant for advances, not relevant for deposits per se. Okay. What PDC have contain the details of all facilities and limits approved for the customer and then sent to disbursement team, the team who is responsible for actually giving the cash to the customer. The disbursement team verifies the pre-disbursement certificate, creates the customer account, master in loan disbursement system. The disbursement team member also assigns the limits for various products as per the pre-disbursement certificate. Then limits assigned, credit limits assigned, the amount is given. Loan disbursement, facility utilization, and accounting of income in the banking system. So once this pre-disbursement certificate is generated, sanction letter is generated, then customer gets the sanction as per the letter. The product requested are offered to customer after verifying the limits in the system, which normally would be there in CBS or maybe a separate system, which later interfaces with CBS on periodic basis. Please understand. Just take this example. Okay. I am highlighting this because there is a lot of change in this aspect. See, again, take this as an example. See, this Punjab National Bank Nirav Modi fraud. So, a lot of components have been identified. Lot of reasons have been written why that fraud occurred. So, one reason we have talked about that. So, what I want you to tell me, what was that reason we have already discussed that led to, that was one of the contributing factors to the PNB Nirav Modi fraud. The second reason was that that I have highlighted. Now, lot of effort has been done to done away with this. So I've highlighted this point. Now, this is not that is being accepted in the core banking system. One of the reason that that PNB Nirav Modi fraud continued for more than 6-7 years and no one was able to track. The reason was that the bank, Punjab National Bank, was using Finacle as a software. This whole fraud was done, it was tracked in a software that was not directly interfaced to the basic accounting system. Please understand. So very good point to learn and understand. So Punjab National Bank was using Finacle at the top. The PNB Nirav Modi fraud, whatever was the document that led to that, it was not directly built into Finacle, but it was built in a secondary software, another software. Now the trouble was that this another software was not interfaced with Finacle. So when you don't create an interface, the gap is going to be there. So after this fraud, a mandate has been drawn that you will not have any transaction that is not interfaced directly on a real-time basis to your Finacle. So this idea about periodic basis is virtually done away with. Even if the idea is that you don't use separate software for anything in banking business. Even if you use, the nature of business is such, then the interfacing has to be real time. Please understand. Real time. Real time means what? You do a transaction in these softwares, automatic update is there. So the periodic basis is also done away with. So periodic doesn't exist like that anyway. Now, okay. So this is, and this is improvement. So it's a learning process. See, please understand, technology is one thing that is very dynamic. So you need updates. So why I've shared these things specifically with you is that we can always improve upon what is already there, what is already written. So that is what is technology about. There are going to updates that we are going to listen to, adhere to, update and write. Okay. So the question that you are answering is, so this is the second reason we have shared that led to PNB Nirav Modi fraud, contributing reason. What was the first one? That is you are answering, we have discussed. Okay. Then in case of fund-based loan, like term loan, overdraft, cash credit, the funds are disbursed to customers' bank account and corresponding. Okay, so that is an accounting transaction. Okay. Then interest is generally accrued on daily basis, the, what you call as daily product based calculation as per the terms of the sanction. Then bill discounting, the customer is credited the invoice amount excluding the interest. So if the banker has discounted the customer invoice, then interest is a upfront debit. Okay, as per agreed rates, and then interest income is accounted on accrued basis. So that is clear. In case of non-fund based facility, the facilities are granted to customer up to the assigned limit in loan disbursement system. Contingent entries are posted on both asset side and liability side. Commission is generally charged upfront. Okay. So before we go to the chart, we have few questions I need to review. Yes, so that is there. Manoj has asked some explanation. SLR, I think. Manoj, you said please explain, sir. So is it SLR or you wanted me to explain this? Yes. Okay. Then segregation of duty. Yes. Job rotation. So the one that we talked about, Manoj also said correctly. Pranay, job rotation. Yeah, Alok, see, please understand. Any fraud that has happened and the volume of fraud, say 10,000, 12,000 crores. So such a large fraud cannot be done without collusion. So collusion for large frauds is part of the system itself. Okay. So job rotation was first. Second, we have talked about. Then Manoj, I'll request you to put this query again. It has been missed in the detail. Upfront, Pranay, upfront means at the time of discounting. So it is there. Upfront means suppose the customer comes and the customer of the bank gets an invoice discounted. That is going to be the payment of that invoice will come after 60 days. So bank is going to discount that invoice today. So the invoice holder will get the money today. So the 60 days interest will be debited to invoice holder's account today. That is upfront at the start of the transaction, at the beginning of the transaction. Like you have the we talked about in reports, the end of day reports and beginning of day reports. So upfront is when you start the transaction. So just for the sake of understanding, suppose 10% is the rate of interest. So if 10% interest is deducted now, so my overall interest cost increases because 10% is not available to me over the period of time again. So that you call as the present value of money. So upfront is now. Okay, Manoj, good. So I got the point. So Manoj, let me tell you, see, what is, let us do it. So slight diversion, but it is good because it helps help us understand how it is flowing. So what I'm explaining, where this non-fund based converts into fund based. In fact, this has been a question in your bank audit and accounts paper. Now, let us do it. So letter of credit. So there are four parties to it. There is a seller, there is a buyer, there is a seller's banker, and there is a buyer's banker. Now, the author of letter of credit, I had asked you in initial discussion. So the author of letter of credit is the buyer. Why buyer? Because see, suppose I am selling goods and this buyer comes to me. So buyer says, I want to buy the goods. I say, I'm ready. But then I am a seller. I need guarantee of my payment. So I ask the buyer that, what is the guarantee? So buyer says, I am giving you guarantee. I'll make the payment. So the seller says, no, I don't know you. I need a better guarantee. So what the buyer does, okay, so buyer says, I'll buy the goods. What I'll do, I'll get a letter of credit written for you. So what happens? Buyer is the author of letter of credit. Buyer goes to the its banker. Whose banker? Buyer's banker. This buyer banker has given a non-fund based limit to buyer of rupees 10 crore. So this buyer goes that my non-fund based limit is 10 crore. I want a letter of credit where the beneficiary is seller. This seller has sold me goods of rupees 1 crore and I'll have to make payment in 3 months. Okay, so all the terms, the goods, the mode of transportation, all details are shared by the buyer to its banker, buyer's banker. Buyer banker writes a letter of credit telling the seller that I know this buyer. I am giving you assurance that if buyer does not pay in 3 months, who will pay? Buyer's banker will pay. Buyer's banker will pay to whom? Seller's banker. So this transaction is routed. Buyer's banker writes a letter of credit, sends to seller's banker, receives and keep it in record. Now, seller has sold the goods because the seller has got an assurance of a letter of credit written by whom? Buyer's banker. Good. What is the tenor of letter of credit? 90 days. After 3 months, buyer has to make the payment. So buyer, if makes the payment after 90 days, good. But suppose buyer fails to make the payment, then what the seller does? Seller goes to buyer's banker. See, I sold the goods because I had a letter of credit issued by you favoring the buyer and I have not received the payment. So please pay my 1 crore rupee. So this buyer's banker pays 1 crore to whom? Seller. And as soon as that 1 crore by buyer's banker is paid to seller, what has happened? This letter of credit was only a document that said that what buyer's banker is saying, please give credit of 1 crore to buyer. I give you assurance that if buyer doesn't pay, I will pay. Who will pay? Buyer's banker. So as soon as this payment has to be made by buyer's banker, because of default of the buyer, this event in banking is called, it's just you can keep a note of it, Manoj, devolvement of LC. Devolvement means buyer has defaulted. As soon as this buyer default is there, this letter of credit, which was a non-fund based limit 3 months back, today, when buyer's banker makes a payment, it becomes a fund-based limit. So this has converted into a fund-based limit. That is how it goes. So Manoj, you have to say yes to it. Generally, okay, but it's like a compartmentalized transaction. The possibility is there, no issues. It is means it can be two distant branches. So the possibility exists. So that facility will be made. Devolvement of LC will be in one branch of the same bank. It can happen. Means I don't see restriction on that, Kuzema. The possibility exists. The State Bank of India has 30,000 bank branches across India. So it can happen like that, possible. Okay. Then, now, so what is the risk for specific products? So now what has been done? So a column has been added because this, I told you this trade finance is a big topic. A lot of discussions could be there. So when Manoj asked the question, so I just thought, but whatever we discuss, it is part of your syllabus, accounts, audit, and EIS itself. Okay. So see, why this discussion is so important and what is the core? See what happens when you are going to use a core banking system. That core banking system is going to support whom? The banker. So your core banking system has to be as per the need of whose business? Banker's business. What banker is doing? The banker is supporting the commercial business. So banker has to support the commercial business. So the transaction flows from commercial business to bank and to core banking system. So if you get understanding of the commercial transaction, please understand, the better you understand commercial transaction, the better you are going to understand the core banking system. Because core banking system configuration is going to start where based on the need of the commercial transaction. So that is the core, that is the theme of our discussion. Okay. Then, so now what is the risk? So cash credit, overdraft, the income for bank is, okay. So interest on cash credits, overdraft, interest included on daily basis. Then demand term loans, what is the income? Interest accrued on daily basis. Bill discounting, discounting income, interest again accrued on daily basis. Bank guarantee, commission, that is accrued over the tenor of bank guarantee but debited upfront. Letter of credit, commission income debited upfront. Then this is the process flow. This way I'm not reading now. You can go through this. So two detailed flowcharts are there. One for fund-based and another for non-fund-based. Now coming to the risk and control. So previous was the income chart. So some discussion we have already done. The credit line setup is unauthorized and not in line with bank's policy. So let us read the control, then we'll have a discussion. The credit committee checks that the financial ratios, the net worth, the risk factors, and its corresponding mitigating factors, the credit line offered, the credit amount, etc., is in line with credit risk policy, and the client can be given the credit line. Now, please understand that when this whole process is being done, lot of assessment where the credit worthiness of the client is being validated, checked. So when you talk of this credit line setup is unauthorized, basically mean that the credit committee, the checking it did was not proper, or when it was proper, the updates it suggested were not properly done. So you require something called as proper credit committee evaluation and proper update of that evaluation in your core banking system. Now, what credit line will mean? So credit line will mean for the nature of facility, the nature of advance, the restrictions, the margin money that you are going to take on advances. So those all are the compliances that you are going to seek on advances. This will be part of the credit line setup. Then the credit line setup is unauthorized and not in line with bank's policy. That may be due to, so second, in the same aspect, second risk can be unauthorized excess. So excess rights to authorize the credit limit has to be restricted to authorized person, and a cap has to be paid. A cap has to be put in place. We talked about it day before yesterday, that delegation of authority. We talked about that the managers, officers, everyone have a delegated capability, capacity in their core banking system. So there is a restriction. Say, for example, a branch manager, she cannot give a loan, a cash credit loan beyond 5 crores. So if a branch manager gets a proposal for sanction of a cash credit loan beyond 5 crores, can he sanction? Can she sanction? No. What has to be done? The proposal has to be approved, sanctioned by the next higher officer. So that configuration has to be there, and reasonably good checks have now been built into this core banking system on this aspect. Then master defined for customer are not in accordance with the pre-disbursement certificate. We have talked about this. Access right to authorized customer master in loan booking system, core banking system should be restricted to authorized persons. SOD exists in loan disbursement system. The system restricts the maker having checker rights to approve the loan facilities booked by itself in loan disbursal system. So how you are going to go about it, how you are going to do it. So that is very important. Whatever there is in pre-disbursement certificate, it has to be properly incorporated in the banking system. Then the possibility that credit line setup can be breached in loan disbursement. This is important. Now, what this means? We'll take with an example. Loan disbursement system restricts booking of if the limit assigned to customer is breached in loan disbursement system. Now, please understand, today the core banking system, the way it is working. So let us take cash credit as an example. So there is a concept of drawing power. Drawing power means the amount a borrower can get against, say, stock statement submitted. So we talked about, suppose the borrower submits a stock statement of 10 crores. Stock is security against which the banker can give a cash credit loan. So against a stock statement of 10 crore, if the pre-disbursement certificate analysis of credit team says that there has to be a margin of 30%. That means against a stock statement of 10 crores, a margin of 30% will be reduced and a amount of 7 crores will be allowed to be disbursed to the borrower. So 10 crores, 30% margin, how much borrower gets? 7 crores. Now let us read this. Credit line setup can be breached. Means what? That the restriction is that 10 crore stock statement, 30% margin, a borrower can get maximum 7 crore. If this has to be breached, means borrower gets anything beyond 7 crores or crosses that, then that is called as a breach. Now I'll tell you how it is actually done in system. Let us read the control. Loan disbursement restricts booking of loans facilities if the limit assigned to customer is breached in the loan disbursement system. So if the limit is 7 crores and it is just going to be breached, the system has controls, the system has restriction, it keeps a track of that. And this breach is recorded in one of the reports we discussed day before yesterday, that is called as an exception report. So everything is documented. You just cannot go beyond system. Okay, then lower rate of interest commission may be charged. Now, this may happen 2 or 3 core reasons. First, the interest has been, I talked about, that today the geopolitical situation, Russia-Ukraine war, the macroeconomic fundamentals are such that interest rates are going up across the world. So wherever bankers have a floating rate of interest or rate of interest that is linked to the what you call as repo rate, that RBI rate on which RBI gives loan to the bank. So repo rates are also going up. So if I borrowed an amount from a bank and my rate of interest is linked to the repo rate or what we call as marginal cost of lending rate, MCLR, or base rate or any other rate, that is fluctuating. So today the interest rates are going up. So the possibility of lower interest rate being charged to my account is what? That whatever updates, whatever additions to the rate of interest are there, they are not being updated timely. That is one. Let us read. Loan disbursement system restrict booking of loan facilities if interest charged to customer are not as per defined master in system. So what is happening? That in this case, the floating of rate of interest has to be updated in master. So that update in master is not going correctly. Now understand the impact of this is phenomenal, because if the interest rate master is not updated, it is not only going to affect my account, it is going to affect all the accounts that are linked to that rate of interest globally in the bank system. So the impact is going to be hugely material. Got my point? This is a system-based flaw that if, see, State Bank of India has more than 1 crore borrowers. And just understand that 1 lakh borrowers rate of interest is fluctuating. Okay. And that fluctuating rate of interest, okay, let you tell me the impact of it. Calculate, use calculators. So 1 crore borrowers of State Bank of India, for example, of those 1 lakh borrowers have fluctuating rate of interest. The total borrowing by these 1 lakh borrowers, which include corporate and individuals and all, total borrowing by this 1 lakh borrower is 10,000 crores. The total borrowing by this borrower is 10,000 crores. The State Bank of India increased the rate of interest by 0.5%. Total borrowing is 10,000 crores. The State Bank of India increased the interest by 0.5%. This update was not made in system. And after 30 days, it was realized that this update is not there. So total number of borrowers 1 lakh. Total borrowing 10,000 crores. The update to interest rate is 0.5%, and the mistake was identified 30 days after today. What is the total revenue loss to State Bank of India? आपको यह बताना है कि स्टेट बैंक ऑफ इंडिया को ऐसा अगर हुआ तो रेवेन्यू लॉस कितना होगा. What is the facts? 1 lakh borrowers, 10,000 crore total borrowing. The rate of interest increases by 0.5%, and 30 days is the period after which the mistake is captured. This is a phenomenal mistake. Understand? Then facilities, loans granted may be unauthorized. Now, again, this is only going to happen when your segregation of duties not segregation of uh, duties functions is not proper. That is very, very important. Then inaccurate interest charge being calculated in loan disbursement system. Now, because the word says inaccuracy, so inaccuracy is basically the formulation is not correct. So you need to improve the formulation. Again, please understand that when the formulation is not proper, that means it's a system-based issue. So it is going to hit all the borrowers per se. So that you need to understand. So see, when you read a risk, just try to process mentally whether this risk is going to affect a borrower or the global impact, the example that we just now took. Okay. So let us see your answers. Yeah, Dhyanesh, credit line, correct definition. Borrower can get money against sanction. Primary margin. Yes, very good, Sharon. Yes, Alok, I'm going to affect all accounts. Let me see the answers. So, yes. So, 4.17. Okay. So, yeah, for 10,000 crores, 30 days interest at a rate of 0.5%. So, 0.5%, yeah, 1 by 12. So, Manoj has given the right one. So, Manoj just gave me the figure also. I want someone to tell exact figure. I don't want to calculate here. Okay. So, 10,000 crores for 0.5. So, 1 verse. Yeah. So, it will be around, yes. The what I calculate right now is yes. So it is yes. So Varsha Shetty has given the right figure. Many of you have written correctly. So it is roughly 4 crore interest loss. Imagine the impact. So that is critical. Okay. So that is why while we were talking about mortgage, my reference to this was this only, that because this is the core of banking business. So it hits a bank huge. Then we've talked about this cash credit. It's 4.17 crores. So now I've got the correct answer. Most of you have said it now. But just understand 4 crore revenue loss for a 0.5% interest that was not updated time lane system. Imagine. And you know what? I'm just taking 1% as an error because the total borrowers of State Bank of India is more than 1 crore, and we are just assuming that only 1 lakh have a floating rate of interest. Just understand. So that is why this topic has a huge impact. The materiality of this topic is phenomenal. Then we have talked about this. Now, so last but one part, reporting system and MIS, data analytics and business intelligence. My personal preference would have been this topic had to be much more detailed, but let us see how much we can read from the module. Yeah. Oh, no, I have to go to the module. Just wait. The next two topics we'll be doing directly from the module. Yeah. Okay. Now, So we talked about Basel. Now you got the point why we I talked so much on Basel itself. So Basel, now you know the word. We have talked about Basel. Today, the norms that are prevalent is Basel 3. Okay. Now, what Basel 3 is? So let us read. So first, we will define Basel 3, and then we'll go back to topic heading again. So we are not reading the regulatory framework or reporting. We are first defining Basel 3, and then we'll go up, bottom up approach. So Basel 3 is a comprehensive set of reform developed by the Basel Committee on Banking Supervision to strengthen regulation, supervision, and risk management of banking sector. These measures aim to improve the just give me a second, just a second. Basel norms. Now, what exactly is Basel? So Basel is basically uh, allowing banks to manage their risk properly. So when you talk about Basel per se, what bankers have to do, lot of risk analysis bankers do, and talk about how to set it right. So all that comes in Basel 3. So here we talked about, yeah, Basel 3 is a set of reform measures developed by Basel Committee on Banking, that is in Switzerland, to strengthen the regulation, supervision, and risk management of banking sector. These measures aim to improve the banking sector's ability to absorb shocks arising from financial and economic stress, whatever the source, and to improve risk management and governance. One of the dimensions of Basel III determining capital adequacy based on risk assessment. So what you are doing in Basel is making that detailed analysis and just understand that the complexity of the banking business has been so high that all this is based on data analytics and business intelligence. Basel has three pillars: market discipline, supervisory review process, minimum capital requirement, and all this analysis today is done through what is called as based on artificial intelligence tools, AI tools. So bank system need to report on that. For sake of understanding, you can write two or three more words we have already talked about. So we talked about the CRR requirement, we talked about SLR requirement, we talked about asset liability management. These are also part of banking reporting system. Then NPF movement. Then you can just write these words, okay, add value to this discussion. NPF movement reports. Then there is a concept of SMA reporting, special mention accounts. So these are like early tracking mechanism, early warning signals which have been built in banking system. Like you have all read that when an account becomes a non-performing, there's a basic time period of 90 days that if the interest is not there for 90 days, recoveries are not there for 90 days, bills are not paid for, they become overdue beyond 90 days, then it becomes a non-performing asset. But then the question is, why you wait for 90 days and then say NPA? Why can't we have a tracking earlier? So there is a reporting mechanism on special mention accounts. So SMA account reporting, SLR reporting, CRR reporting, ALM reporting, NPA movement reporting. So these are all that come from the banking MIS that is put to use. Very, very, very important. Then coming to the last topic for the day before we go to the MCQ, that is applicable regulatory and compliance requirement. Now, so the technology impact, money laundering, cybercrime, and banking regulation act. Let us take one by one. So impact of technology. So just understand that the banking policies, procedure, the regulatory structure, the organization structure, the business process, they are all affected by technology. And because technology is affecting all of them, what we need to create better controls to manage it. So this is how, when you look to banking per se, we have taken lot and lot of examples on sharing with you how technology is affecting the whole process of banking. And last 25 years, 30 years, banking has revolutionized. We shared, you also shared that many of us have not physically gone to the bank, which has our saving bank account. It's a revolution. When we were articles like you 25, 30 years back, so we had to go to the bank to put our stipend check. We had to go to bank to get the exam DD prepared. So when this exam DD preparation concept was there, then we had this we used to all go to one of the designated banks in our city was State Bank of India, where they will make a cash DD for exam fees. So it was a big process because you had to go to the bank branch and there was only a designated location where you get those DDs. And there were big queues, and then you had to fill a form, tell the purpose for which that amount is needed. But today, it's all done away with. Why? Because technology has allowed what you all have been doing, online payment of fees. So a lot of structuring has been done, and that is creating an impact on the whole bank per se and the whole banking business per se. Then, next very important topic is, yeah, money laundering. So yes, good, Dhanish. So we'll take the details from the module itself. Now, so here it is. So that is answering Dhanesh's question. Okay, I'll go back to that, Sharon. Now, money laundering is a process by which proceeds of crime and true ownership of these proceeds are concealed or made opaque so that the proceeds of appear to come from legitimate source. So what exactly is money laundering? That a fraud money or a money that, say for example, there is a bank robbery and bankers take away 10 crore rupee from the bank, and through some way, through innovation, they are able to feed that 10 crore back in regular economy. So that is money laundering, where you are basically able to conceal the source, conceal the location, conceal the origin of your money. The objective in money laundering is to conceal the existence, the illegal source. So what you're basically hiding, source, because your source is illegal, like that, or illegal application, you're applying it for different, not good purposes of income to make it appear legitimate. So wherever you get this money from, this illegal source, illegal application, and then create a whole process, create a flow of that transaction that make all believe that it is genuine, then that is money laundering. It is commonly used by criminals to make dirty money appear as clean. Now, dirty money, it can be various sources. That is not the topic to be discussed, but we'll find some references in the next header. Yeah. So placement. So there are stages of money laundering: placement, layering, and integration. Let us take one by one. The first stage involves placement of proceeds derived from illegal activity. Now, so let us take this as an example. Illegal activity is a bank robbery. The movement of proceeds frequently currency from the scene of crime to a place or into a form less suspicious and more convenient for the criminal. So, what some way the money that the robbers have taken from bank, they are able to some way show it as or bring it into the banking system. So, from this, the dirty money, the robbery, the amount is put in bank. In this stage, the illegal fund or assets are first brought into financial system. So from the source of crime, they bring the amount to a financial location. So it can be bank, it can be anything. It can be bank, non-banking finance company, anything like that. Okay. Then that is placement. We'll read, then come back to again this diagram. Layering. Layering involves the separation of proceeds from illegal source using complex transaction designed to obscure the audit trail and hide the proceeds. Now, let us read what layering will mean in this flowchart. So what happens that when you layer, so what you're doing, so the money has been received, you do a very complex transaction. If you can just see it here. So from the bank, the money is sent to a company X, then X sends it to a bank outside India. Then this bank outside India gives loan to company Y. And this loan again brings the money to X. So because the route is appearing that the money is coming from outside India or outside the country of origin, it appears like a genuine. So layering is trying to give more genuineness to the transaction, trying to obscure, trying to make it absolutely opaque to the where the money has come from. So once layering has been done, integration. Now, once you have ensured that the money appears as a genuine money, then you can do anything. You can invest in share, you can buy property, you can say, invest in companies, deposits like that. Then it becomes an integration. So conversion of illegal proceeds into apparently legitimate business earning through normal financial commercial operation is what is integration. So placement, layering, and integration. That is. And please understand, today, in fact, this brings us to a topic that we talked about. I told you to write in a topic present status, that was cryptocurrency. Please understand, all central bankers across the world are worried about the application side of cryptocurrency, where it is being used and where it is coming from. So cryptocurrency, the key USP, unique selling point of cryptocurrency is non-traceability. And because it is non-traceable across the globe, the central bankers and the governments are worried that cryptocurrency may be used for money laundering because it is non-traceable. You just read the 3 steps: placement, layering, and integration. The 3 steps are virtually all incorporated together in cryptocurrency. So it's a very genuine worry that all governments across the world have. That is why this cryptocurrency is not being made a valid tender in India and many developed countries also across the world. There are other reasons also for not allowing it, but this is one of the core reasons. Okay. So why I brought this example of crypto? Because second heading is exactly that: anti-money laundering using technology. Crypto is using technology to do money laundering. That is. So negative publicity, damage to reputation, loss of goodwill, legal regulatory sanctions, and adverse effect on bottom line are all possible consequences of banks' failure to manage money laundering. So money laundering has its own very huge risk. Banks face challenges of addressing money laundering. Yes, in fact, globally, there are group of nations which have formed a coalition where they share with each other details about money launderers, the people who are doing it. So that is basically ensuring that money laundering can be tracked across the globe. So that is ensuring that you act on money laundering. Then one of the issues is money laundering may be used for financing terrorism. In fact, uh, globally, when detailed analysis of fundings for terrorist activities have been done, so one of the core source of fund was laundered money. So laundered money means that is generated from illegal or unethical businesses. That includes drug selling, like that also. So that is used for financing of terrorism. The next very important topic is cyber crimes. Now, see, Information Technology Act 2000, as amended by 2008, it's part of the syllabus. Lot of discussion we had in our discussion, lot is there in other modules also, we have read it. So what exactly is cyber crime? So any crime that is done through use of technology is cyber crime. Why cyber crime today is very critical, or why it is the point of discussion? Because technology is used, the value that cyber criminals are able to generate through these crimes has gone phenomenally high. Billions of dollars every year are being lost due to cybercrime. That is why it has become very, very important. And you see this definition of cybercrime as given by United Nations manual. Please read it. Just have an update to this. Read this along with the definitions you have read in Information Technology Act. I am just referring to the section 43, section 65, 66, then 66B, C, all capital, 66B, C, D, E, F, 69. So these are where you find this crime definition and penalty prosecution in our Information Technology. Just keep a copy of these. So this is United Nations definition. Just for sake of understanding this one, I'll just highlight. This is, say, one of the definitions given in our 65 section also. So just keep a tag of it. Then what we are reading is the applicable laws and regulations. So first was introduction, that these are the sources of those laws. And second part is Banking Regulation Act. All banks in India are governed by Banking Regulation Act. So you need to read through the provisions. You already have detailed discussion at other locations also. Then Negotiable Instrument Act. So this whole idea about electronic transaction. So this Information Technology Act has objectives. Those objectives have led to amendments to Negotiable Instrument Acts also. So just keep a tag of it. The changes brought to this act. Then Reserve Bank of India regulations, which is the governing of all banks in India. I told you that we'll share an example about that home loan. So what value of home loan can be given, how the tenor has to be generated, how can a borrower get a home loan for second house. So all those considerations, Reserve Bank of India's detailed guideline. Now, if I am a banker, I need to ensure compliance with RBI guidelines. Now, if I am a banker and I am using a core banking system and Reserve Bank of India has given some guidance on home loan, so all those things have to be all those guidance of Reserve Bank of India need to be incorporated where? In my core banking system. That is important. Then the RBI is a monetary authority. It's a regulator, supervisor of this financial system. It is the issuer of currency in India. Okay. Then Prevention of Money Laundering Act, PMLA. So I'll request you to read through the sections. Please carry this section, section 3, then section 12. These are important. We'll just read the headers. Yeah, sorry. So section 3 is offense of money laundering. So it defines who may be held guilty Whoever directly or indirectly attempts to indulge or knowingly assist or knowingly is party or is actually involved in any process or activity connected with proceeds of crime, including concealment, possession, acquisition, or use and projecting or claiming it as an untainted property shall be guilty of offense of money laundering. So if you have dirty money and you present that it is not dirty money, then it is a money laundering. Then section 12 is the period for which entities need to maintain their records. Okay. So just keep a tag of this section. Then section 13 is power of director, the that can enforce fine on people who are involved in money laundering. Then punishment for false information or failure to give information when asked for offenses by companies. So I'll request you to go through this. Then Information Technology Act 2000, as amended in 2008. We have talked about lot of sections. Just let us see. The numbers are here also, I think. So just key, yes, this exactly these sections we just talked about. So 43A, I didn't say. So just keep a tag of it. We have discussed 43A with more examples, 43 capital A, then 65, 66, 66B, C, D, E. They are already part of your module, chapter 1. Then this is important, 43A, sensitive personal data information. We have talked about that any information that you as an entity has of your customer, then responsibility of security control of that data information resides with you. Every entity has to have a privacy policy about the data. Every bank, just understand the impact of this. And it will be very, very important for bank because the bank has so much data. You are giving KYC to the bank. So you are giving your PAN number, Aadhaar, voter ID, date of birth, earning also, because if you are taking a loan, so lot of data you are giving. Imagine that data is hacked. So that is why this 43 capital A is a very important sections for bank to comply with. So they need to have this privacy policy built. Okay. So we've talked about the Banking Regulation Act also. Now, so we are on the last part. Let me take the queries, then we'll go to the uh, we'll go to the query after this. Yes, Sharon, integration. Okay. It can be anything. Okay. So let us, I think we are on the, yeah, we have talked about this. Let us go to the MCQ for the day. Just give me a second. Yeah. Just read it. Sorry. So this is the first reading you have, and then I'll bring the question. Okay. Basal slide, I'll bring Shak. After this MCQ. Bharat has shared a movie in Tamil that is made based on money laundering. Okay. So I'm refreshing your answers. So first answer, I'll bring the Placement. Great. So I got the first answer on my chat from Parthasathi. Yeah. So Parthasathi, Sharan, Piyush, Khuzema, Alok, and Dhanesh. I got the correct answer from them. Second. So, second, all ABC options have been given. Let us see the correct answer. Integration. So with the life, that flowchart is a good way of learning. So let us see who got the correct answer. So Piyush, Alok, Manoj, and Pranev. Good. Then Patsarsi also got it correctly. Yeah. Good. So I think C was the third question was a giveaway. So we have Dhanesh, Alok, Kuzema, Sharan, Vinay, Priyanka, Malge, Jyoti, Pranay, Piyush. All correct. Great. Then Varsha Shetty is also correct. Khushi is correct. Patsati is correct. Yeah. Manoj is also correct. This I've discussed separately, huh? This the fourth question ABC answer we did talk about, means even if you don't say it directly, probably in the module, but we did discuss it. So I need the correct answer. Okay, yes, Alok. So let us see the correct answer to this one. CTR, cash transaction report. Just keep a note of it. Okay. So well, please remember it, huh? Cash transaction, CTR. Yeah, Manoj gave the correct answer and Parth Sathi. Good. Sharon also gave the correct answer. Alok has answered 5A. Oh. Yeah, Mitesh Bhai said C. I think that is for 4. So one more answer of 5th and then I'll bring the answer. Now, it is 10 years. So there's an update pending. Just keep a note of it. I just rechecked it. It is 10 years. Just keep a tag of it. Okay. Then our friend Sharon wanted the basal slide. So I'll bring it back. Now, that is thanks, but wait here. I have to show the basal slide as requested by Sharon. And then you can ask any query from all the chapters we talked about. Yeah, here it is. Sure. So, yeah, Vinay. Okay, great. Thank you, Vinay. So, there is an update. Thanks. So, any query from any chapter means it's not that we are on the end of the batch itself. Uh, you can ask that query. See, understand that even if you have query beyond this class, you already have institute's email ID, EIS dash enter at the rate ICIS. So any query you have, please feel free to send it to the institute. Institute will, if it feels, it comes to me and then I'll answer that. So just keep a tag of it. It has been a learning experience. I enjoyed a lot talking to all of you. Dhanesh says, see you in CA final. Yes, I wish to meet all of you. In fact, uh, our institute has this system audit as a post qualification course. So I'm associated as a faculty there. So I'm jumping a step, Dhanesh. So I don't want to meet you in CA final. I want to meet you in the post qualification course, so that this ensures that my best wishes for you to clear inter final and then we meet after final. So that is my wish for all of you. Then loan disbursement is so I'll answer the queries other than the other things we are writing. So Pranay, that Gmail ID is available. Okay, I'll just see if I can share that. I'll just share that Gmail ID. You keep a tag of it. Then loan disbursement, Priyanka Malge has asked. So loan disbursement is that, see, once bank has sanctioned the amount based on papers, KYC, income statements, whatever the case, when they transfer amount to your account, that is disbursement. Sending from bank to your bank, your account, that is. Then Sharon, okay. Then I'll just share the Gmail ID of the institute. Okay. Now, Dhanish, during the course, we have been talking about then few of the MCQs that I shared, they are case study based MCQs. So that can be done. I'll request all of you to refer to the institute case study booklet. They have prepared that booklet around 130 pages, but it has real good case studies and questions. So to refer to that mock test, revisionary test paper, do refer. Exam tips we have been doing during the course of discussion. We have done a lot. There's just one more thing I want to share from the questions you have put it to me. Email ID. Yeah, email ID is Dhanesh is available in app, but I'll just give me a second. I'll share that mail ID. I'll put a slide to that. Just give me a second. Now that email ID is visible. Just you can just keep a tag of it. Yeah. Jyoti, how to answer, say, MCQ based question or case study based MCQs? So read the case study, try to get into the underlying topic that is there. And then you get, believe me, each of the case study has good hints, like we did for this bank. So it already has very good hints to tell you what they are seeking, what they want you to answer. That is the point. So Pranay, you got the email ID. Then some few of you are asking something that I cannot share. Okay, so good. So it has been pleasure. Any more query? Just last 30 seconds, and then we'll close. My best wishes to you for clearing this exam, next exam, and so that we can meet when you take any post qualification course like that. Okay, thank you. So we are closing. Bye. Good night. Best wishes again.